From the morning reading, healthcare at zero. The healthcare sector has been one of the strongest areas of the market over the last few years, driven largely by the biotech group, but lately not so much. In fact, in the S&P 500, there is not one healthcare stock trading above its 50-day moving average. The Russell 2000 index of small cap stocks has sunk to a new low, violating its low from the mini panic in August. Yet the S&P 500 and most other indices are still holding above their own lows from August. Despite the Russell's reputation for being a leading indicator, other times it led the S&P to a new low did not lead to below average performance for stocks. The market CDX North American High Yield Index jumped 20% on Monday. That's the largest jump in at least a decade, as traders scramble to buy protection against widespread defaults in high-yield bonds. A month after the 5 times it jumped 15% or more in a day, the S&P 500 was higher each time by an average of 3.1%. A month after it jumped 10% or more, the S&P rose 13 out of 18 times. Hello, this is Stephen Harris, the head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:55 a.m. Central Time, and I'm recording this in preparation for the market day of September the 29th, 2015. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. Let's go ahead and dive into our overnight activity. And much as we kind of expected with the really high trend and so forth at the close yesterday, obviously we've had quite a few days in a row of down now, including a big down day yesterday. We'll look at the charts in just a moment, but a bit of an overnight bounce. At the time of this cut, the S&P futures were up over 0.5%. Russell was up about 0.25%, NASDAQ up over 0.5%, and YM, or the Dow futures, something just less than 0.5%. Crude oil was up about 1%. Euro was scratch. Bonds down about 0.25%, and gold down about 0.5%. In overseas action, a lot of weakness out of Asia. China was down over 2%. Hong Kong almost 3%. Japan down over 4%. Germany, at the time of this cut, was about 0.25% up, and United Kingdom was down about 0.5%. In terms of the macroeconomic reports for today for the U.S., those were important. Consumer confidence, which comes out during the market open hours. Also, there's a good trades balance that comes out before market open. And lots of stuff on tomorrow. I didn't have time to room to put it on this sheet, so it's not here. In terms of the market condition, big day yesterday. 2 standard deviation moves on the S&P, the Russell, and the NASDAQ, and a single standard deviation move put in by the Dow. So big move. IV percentile, so still kind of middle of the pack for the year. 54, 51, 53, and 60 respectively. You see the skew here, almost to 135. That certainly is a sign of potential continued multi-standard deviation moves to the downside. Short-term VIX, look at this, over a 30. So obviously a big pop there as well. But also notice this closing trend. When you get a trend over a 2, it's often expected to see something of a relief bounce, at least in the short term, particularly in that following overnight. And that looks to be what we had. In terms of our regular daily report, Continue to see a lot of ugliness here. We continue to be phase 2 trend breaking, IBD status, market in correction, does not get worse than that. Accumulation distribution did get worse yesterday. The S&P score dropped to an E, joining the NASDAQ at that E. GMI index 0 out of 6. That author remains in cash. Primary market condition remains strong bear. You have the decision point scoreboards, lots of down arrows across all the different time frames still. Overall consensus for portfolio investment posture at this point is clearly very, very bearish and just about cannot get more ugly. In terms of the intermediate term market posture, that is also solidly bearish. You have a 24.6 in the S&P. If it goes below a 20, this will go severely bearish. The Dow 38.6. NASDAQ joins the bearish crowd at dropping to a 50, and the Russell also on the cusp of going to severely bearish. In terms of position sizing opinions, obviously from a portfolio position sizing opinion, it's at 0, and the active trader based on volatility is at up to 50%. So very, very, very conservative position sizing opinions there at this time. Hedge warning status remains at a level 2 plus, and I have to say I debated whether to take this to a 3. And one of the primary reasons I didn't go to a 3 is I kind of expected something of a bounce, at least at the beginning of today. But this continues to be a highly elevated risk level in the market. And remember, this is not a prediction the market is going to go down or how far it's going to go down, but it is an assessment of how much risk there is in the market and what is the potential for significant drops. And that risk is clearly at a 2 plus at least. In terms of the volatility based metrics, we also saw some deterioration in this area. Warnings in market in decline, sharp increase warning. We also had a VIX spike yesterday, and we also had a ratio warning come into place yesterday. VIX is still up over 18, of course. Distribution day count is in reset mode while the market is in correction. In terms of New York Stock Exchange new highs, new lows, look at this, 1,050 stocks setting the new 1 month lows against only 23 at new highs. So it does not get much uglier than that. All 5 key intermarket risk aversion indicators are flagging as risk off. So when you roll all this up to the special opinions, no change from yesterday, but clearly need to be exceptionally conservative in the initiation of new positions, and for novices in all 3 strategies is really either not acceptable or very borderline acceptable, and just nibble with your setups. Let's go ahead and go to the charts. In terms of the SPX, I mean, look at that big red candle here, and closing in on those important swing lows that we have been expecting ever since we had this break, this candle here, where you had the post FOMC and the rejection intraday within like an hour of that announcement, and then that followed through the next day and crashing down through the previous diagonal support line, and it's been ugly ever since then, and yesterday just accelerated that process. If you look at this, you know, you went from a high in the, we'll call it the 2020 area, to a low yesterday in the 1878 area. This has all happened in 1, 2, 3, 4, 5, 6, 7, 8 trading days. So about a week and a half of trading action, and we have come down, what is that, about 140 S&P points. So pretty significant drop. Only one real significant bounce along the way, and that was this one here, which had a close below the backside of the diagonal support line. So really very, very little for the bulls to get excited about. We'll see if we end up having a bit of a relief bounce today. I still as hypothesis A, expect that we're going to visit this area of the swing low. And remember, the area can be defined as anything within 1 or 2%. It might undercut it a little bit. It might bounce just above it. But that we first of all expect that we'll see a visit of this area. And indeed, if we get any kind of significant bounce today, that could be just another bear flag and an opportunity for people to take new short positions with the expectation that this is going down. Now, if this is truly a new range, we should see this area hold. If it does not hold, then things get really, really quite ugly. Obviously, you got last October's low is looming down there about 45 points away. And that would be the next likely area of any kind of significant support at all. And at 45 points, that's one day in current market conditions. We could find ourselves very, very quickly moving to that area if this area does not hold. So you could see why we're at hedge risk level 2 plus. And you could see where it was not that long ago. This is the days just before the Memorial holiday, albeit in very weak volume, that we made this new high here. And we, at the time, called it very suspect that an all-time high would be made on such low volume, and it was promptly, summarily rejected. And we've had a couple visits back to that area since then, back when we were trading within the range. But ever since we have broken down, it has been decidedly bearish. We had a short term, about 3 weeks here, in which we thought, well, maybe something's building here, but then that broke down, and then we just laid down to the next level. In terms of the others, the Russell is the story. The Russell did break through that important, and look at this, with some earnest effort, big red candle, but more importantly, did not even pause with any kind of significant bounce at that previous level. So if indeed the Russell is the leader, then we are likely heading to these last October lows, and we would have a very, very ugly September-October fall season for stocks in this year as well. Seems so often we talk about weakness at this time of year, and certainly this year is not the exception. NASDAQ has also been decidedly weak since the FOMC announcement, though from a relative standpoint it has a significantly further distance to go to get back to that swing low from August. The Dow Jones is closer to mirroring the pattern of the S&P. So very interesting times we are in. Primarily, the key takeaway from all this is that in terms of the initiation of new positions, very, very improbable that initiation of a new covered call or even an option income strategy, or even the most conservative way to start the process of selling puts on positions that you're willing to own, any of those kind of strategies at this point would seem to be very, very low probability to being able to reach targets. Now, of course, one of the things you got to keep in mind is just when everybody thinks that we're going down, that's when the bulls can rip your face off. And indeed, always remember that the biggest bullish days often come during bear markets. And we could have, one of these big giant green candles when, and 2 days later, it seems like you're 3/4 the way back to the highs. So always be prepared for that. We definitely have increased volatility conditions at this time, and that's certainly part of life in down markets. So in terms of sector specific, it doesn't get much uglier than this. Only utilities holding up in terms of a couple of the time frames. Everything else all red all the time. In terms of sector specific, even utilities, and this is one of the points we've been making, that when you have a big down market, even if your sector is the blessed one that has been in relative strength holding up, that doesn't mean that it's an absolute hold up as well. And indeed, from an absolute basis, utilities were down over 0.5% yesterday. And even if you look back, you can see just barely green at the 5-day, slightly green at 3 months, and slightly green for 1 year, but the year to date's down 10%. So very, very difficult sledding in any sector, any industry group to speak of in a broad sense at this point. So that should be enough for the review for today. Remember, we've announced this yesterday, and we'll continue to highlight this for the next few days. But in collaboration with the Chicago Northwest Berg Trading Club, there is a new course offering. It's a 40-hour course in self-directed active money management, a 10-week course, 4 hours each session, plus some bonus sessions, 43 hours of educational material. This is the 9th time that Nick has taught this course. He's got this down pat. And of course, the purpose to this is to cover topics of interest to self-directed investors and those seeking to trade for a living. This course will start on Saturday, October the 10th, running 4 hours each day, and will be done live in person in the Chicago suburb of Schaumburg. For those of you who are not in the local area, you may also participate in this course through a simulcast to the web, and that will be made easily possible. There'll be recordings of the classes and all as well for those folks who want to participate with the class, but yet are not necessarily available due to work or some other cause on Saturday mornings for either one or all weekends. You can very much participate. For details and to sign up, go to this website right here, and that'll give you all the details about the course description and the like. So we're quite excited about that collaboration effort. In terms of what you've gotten from us today, if you like what you're getting here, please retweet us to your Twitter followers, to your StockTwit followers, like us on YouTube. Of course, subscribe to our YouTube channel. Email support at falconglobaltraders.com. More information about what we do at Falcon can be found at this website. Disclaimers as always, hit the pause button if you need more time to review this. And we look forward to seeing you back here tomorrow morning before the market open with the market preview from Falcon Global. Good trading.